Question number one, are we expecting a weaker US economy in the second half of the year? I guess I'll spoil this up front and say possibly, probably even. If you look at where the economic data has been coming in during the second quarter of 2025, it's been mostly disappointing. And that disappointment has actually been accelerating over the last couple of weeks, even the last few days. This graph is through this morning's poor new home sales data. Almost all the economic data that we're seeing coming out of the US is falling short of expectations. That doesn't mean we're in recessionary levels. It just means that the economic data is not coming in as well as we expected and as the consensus expected. And there's two ways for this to resolve. We can either see expectations fall or we can see the economic data start to turn better. Expectations have already fallen. One reason why you haven't seen a bounce back in economic forecasts, the same way you've seen a bounce back in equity markets, is that the preponderance of the data continues to come in below expectations. This is a very different story than we've seen in the last 2 calendar years. In both 23 and 24, as we pointed out coming into the year, expectations were pretty soft to start those years and were revised up during the calendar months because the data came in better than expected, especially the consumer data. That has not happened in 2025. We came into the year with very high expectations, especially as they were being revised up in the fourth quarter. And those expectations have fallen significantly to the point where we're now expecting consensus is expecting 1.4% GDP growth for the year for the US. That would mean that we're annualizing at about 1.6% in the first half of the year. That would mean somewhat weaker growth in the second half of the year, though not catastrophic recession level growth. One thing that we've been interested in is watching is the betting markets. These are not useful for every single thing you can look at. Anybody who's watching the betting markets during the New York mayor primary last year knows how much they can move around. But for recessions, what we're interested in is the perception that the US is in danger of falling into recession has fallen significantly since April with the announcement of those Liberation Day tariffs. Since then, we've seen them fall as those tariffs were walked back and as very little of the data looks recessionary. But at the same time as we're seeing the average expectation for growth fall, we're seeing the recession odds fall too, which all that means is your average expectation is falling, but the uncertainty band around that is also closing in. So instead of thinking that there's a wide band of uncertainty around where growth could be this year, it looks like consensus is forming around a slower growth rate, but without as much of a left tail risk in the form of recession. And one of the reasons is that because the tariffs are not as severe as first put into place in early April. One thing we are watching though is that the unemployment level is continuing to move up. This is the absolute number of workers classified as unemployed. These are people in the labor force, but not currently working for economic reasons. And that number has been coming up. It's over 7 million now. It's come up for 4 straight months. The unemployment rate has also been rising slowly. That's pretty unusual. You can see on this graph, those black lines, when they're rising, they tend to rise very quickly. Unemployment sort of takes hold in the economy very quickly, and recessions happen sometimes without much warning. But this time around, we're seeing this happen very slowly. So it's a historically very different type of environment. But in the coming months, this is likely to move higher, not lower, even with the contracting growth in the size of the labor force. And you can see consumers also perceive this as well. One thing we really think consumers do a good job of identifying in these consumer confidence surveys is how healthy the labor market is. Do they know somebody who just got a job? Do they know somebody who just lost a job? Do they have a friend who just posted in their window a job opening? And the perception among consumers, and that's this black line here, which is inverted, is that the labor market is getting a bit worse. The ratio of jobs being easy to get versus jobs hard to get is turning a little bit against us. And that is typically happening as the unemployment rate is rising. And this indicates that there could be a further rise ahead in unemployment. The last thing I'll just identify here on the macro side is business sales. When small businesses are identifying poor sales as one of the things that's becoming a problem for them, that tends to also happen at a little bit ahead of when unemployment's going to be rising, because one of the things that small businesses obviously can do in response to poor sales is to lay off workers. In that context, I mentioned tariffs a little bit. One of the reasons why there isn't seen as the sort of the cavalry coming to the rescue here with lower interest rates from the Fed and a lot of stimulus coming in the very near term is that inflation is also a significant fear. So what we could be seeing this year potentially is a repeat in a muted sense of 2022 when we saw growth fears and inflation fears take hold at the same time. Some people call that stagflation. What we aren't seeing, though, in the data through the month of May, so significantly into the year, is evidence of higher inflation. In fact, inflation seems to be on a glide path down to close to the Fed's 2% target. The last 2 months in particular have been very soft, and we're expecting that the PCE data for the month of May that is going to come out this week is also going to be soft. That's the one the Fed really pays attention to. So all signs here at the top level pointing to pretty quiet inflation, but we know the expectation of many economists and of the Fed is that inflation is going to be higher in the summer months because of the impact of tariffs that take a little bit of time to set in. Consumers are onto this. You ask consumers about what inflation is going to be over the next year. They have these very, very high forecasts that are completely unprecedented, except in times when the gasoline price is spiking, which has not happened. You can see that black line has been below zero. We're in a falling gasoline price environment for the most part, but inflation expectations have gone to the moon. And the reason that's happening is consumers are concerned about tariffs and track tariff revenue, daily revenue. This is looking at it averaged over the last 2 months because it's a very jumpy, bumpy series. But you can see that the U.S. is taking in a lot more tariff revenue, which means that things coming into the country are being charged those tariffs. Maybe not completely in totality yet. We probably haven't seen the full force of the tariffs in terms of the daily revenue impact, but we know that that is potentially going to be leaked through into higher prices. Where do we expect we're going to see this? Goods, especially durable goods like cars, where we know there are high tariffs already in place. Anything with steel and aluminum, which are also have very high tariffs attached to them as components, also potentially could be rising in price, but that's going to take a while. Inventories get wound down, existing because of things on the shelf get bought and sold, and then only then do you have to import new things and pay those higher tariffs. But this has already started to show through in car auctions. So auctions for used cars are starting to show signs of inflation already ahead of what we think is going to be the major impact from the tariffs. Where are we not going to see as much inflation or actually see less inflation? In rents. Annualized monthly rent changes have become very soft, very normal. We can actually see this line go even lower. So if we're annualizing a significant part of the inflation index, CPI, PCE, which is shelter, at a lower rate, that's going to make up for a lot of the increase in inflation we're likely to see from goods. So there's a little bit of a seesaw going on. Services inflation is likely to be coming down regardless of what's going on with the tariffs. Goods inflation is likely to be coming back up. And net, we might not see, in fact, we don't think we're going to see nearly as big a spike in inflation as we did in 2022. Last point on this as we transition into the policy question, especially as it concerns rates and bonds, the deterioration in the macroeconomic data has not had as much of an effect on the market's perception of what the Fed's going to be doing, and indeed even the Fed's own forecast of what it plans to do, as it normally would. This black line hasn't really moved down that much. That's telling you where the market thinks the Fed funds rate's going to be at the beginning of next year. Come down a little bit in the last few days on some dovish commentary and some weak data, but not as much as that economic data surprise index, which has been cascading, would have you think. And the reason is that the Fed is still cautious about the inflation outlook. It still has to weigh these two risks against one another. It can't only pay attention to the slowing growth data. So the third question is, can bonds continue to be a hedge against weaker growth now that we have this sort of dual risk scenario in the ether? Karen pointed out the zoo steepener that we've seen in the U.S. Treasury yield curve. This has been a really powerful story for bond investors, for bond markets. Compared to a year ago, short-term rates are considerably lower. The Fed pulled those rates down. You can see by the shape of the very short end of the curve, the 2-year rate being low, the 3-year rate being low, that rates are expected to fall further. But further out on the curve, despite the fact the Fed cut rates last year, the 20-year rate and the 30-year rate are higher than they were a year ago. There's many reasons for that. One of them being lingering concerns or emerging concerns about the state of the U.S. fiscal situation. You haven't seen, again, similar to the Fed funds rate graph that I showed just a minute ago, for the amount of economic deterioration we're seeing, we're not seeing as much of a hedging property in the 10-year Treasury yield as we might otherwise see. There's something else keeping this yield aloft. One of the things is the perception, we think, that there's going to be this large fiscal impact, this large impact to the deficit, and potentially a stimulative impact to the economy from the One Big Beautiful Bill, OBBB. What's interesting about this analysis, though, is it leaves out the impact of the tariff. So when you look at the Congressional Budget Office, which tries to analyze each of these things in isolation, the impact on the deficit from the One Big Beautiful Bill, which is estimated to be about $2.8 trillion additional borrowing over the next 10 years, is almost completely offset by, or exactly offset by, the additional revenue that will come in from the tariffs. And this allows for changes in interest rates that will result from these policies, changes in economic growth. So this is all dynamic. It's an estimate, but the fact that these numbers are so close together leads us to think that the market may be overestimating on both sides the degree to which this is going to be a market-moving fiscal policy environment that we're in. Is it going to be extra stimulative with lots of new deficits and borrowing? Not if the tariffs stay in place. Is it going to be a complete disaster from a fiscal standpoint and be this huge tax increase on households and businesses from the tariffs? Well, there's also a lot of stimulus happening at the same time. So the fact that these two things offset each other leads us to think that there shouldn't be a huge impact, perceived impact on the debt and the deficit moving forward. The one thing we would say does need some relief in the form of lower interest rates is the housing market, which is, I think everybody on this call knows, has not been functioning normally for at least a few years. The fact that mortgage rates remain so close to their highs for the cycle has led to kind of a semi-permanent decrease in demand. That worked for a while not many people were listing their homes, but now that they are listing their homes, we are starting to see prices come down. The latest numbers we got just for the month of April, we got those yesterday, from both the government and the private source of home price movements. Both of those have home prices moving down in the last 3 months. And that's a concern for the consumer outlook. That's a concern for the overall economic outlook, the perception that if your house is not worth as much as you thought a month ago or a quarter ago, you might behave differently as a consumer. So that's something to watch. Still want to approach this from an investment standpoint. Where are the opportunities in bonds? If we don't think there's a big fiscal blow up about to happen, but bonds still seem attractively valued in many respects, we want to know where to look for that source of opportunity in the markets.